Imagine owning a stock you already like and getting paid simply for holding it. That's exactly why many investors use a strategy called writing covered calls. But there's a catch. If the stock suddenly explodes higher, your upside can be capped. Welcome to Valkyrie Simple Finance, where we like to help you understand before you invest. Today, we'll break down how covered calls work, why many investors use a strike price around 10% above the current stock price, and the risks that you absolutely need to understand before trying this strategy. Let's start by reminding ourselves what an option is. A call option gives the buyer the right, but not the obligation, to buy a stock at an agreed price, called the strike price, either at or before an agreed date, called the expiry date. And for this right, the buyer pays the seller of the option a fee, and this is called the premium. Now, the seller is also known as the writer of the option. From the seller's perspective, he has an obligation to sell the stock to the buyer at the strike price if and when that buyer exercises his option. Let's use an example to show how this works. Let's consider a case where you purchase a call option on a stock, XYZ, at a strike price of 110, paying a premium of 2. A typical call payoff diagram illustrates this visually. The horizontal axis represents XYZ's price movement, whilst the vertical axis shows profit or loss. If the XYZ stock rises above 110, your call option becomes in the money. Once the stock price exceeds the strike price 110 plus the premium 2, the buyer of the call option starts making a net profit. That's if he exercises the right to buy the stock. If the XYZ stock stays below 110 at expiry, the option is not in profit. It becomes worthless, and the buyer has lost the premium of 2 that is already paid. So the diagram shows that the potential profit to the buyer of the option is theoretically unlimited, whilst the losses are always fixed. The maximum loss is the premium that he has paid, in this case 2. So now, what is a covered call? A covered call means that you sell or write a call option, and at the same time you own the shares. The word covered matters because your shares cover your obligation if the option buyer decides to exercise the option. The writer of a covered call can lose the stock on which he has written the call option, and he will have to sell it at the strike price in the option contract if the buyer exercises the option, regardless of how much that stock is now worth in the market. It is important to note that one standard option contract normally controls 100 shares of the stock. So if you own 100 shares of a company, you can typically write one covered call. If you buy one call option, you have the right to buy 100 shares at the strike price agreed in the option contract. One common covered call approach is choosing a strike price roughly 10% above the current stock price. So, for example, you own 100 shares in XYZ company, and if the shares are trading at $100, you might sell a call option with a strike price of $110. Now note that your 100 shares are worth 100 times $100, i.e. $10,000. You sell the call option, which means that if the buyer exercises the call, he will pay you $11,000 to take the 100 shares. So why do investors do this? This approach attempts to balance three things. First, generating premium income. Second, still allowing some stock appreciation. And third, increasing the chance that that option expires worthless. Again, let's look at an example. Suppose you own 100 shares at $100. You sell a covered call with a strike price of $110 and collect a premium of $2 per share. That means you immediately receive $200. Now, the best case scenario is for the stock to stay below the strike price. This is the ideal outcome. Stock rises modestly, but stays below the strike. The option now expires worthless. You still keep your shares, and you've now got the premium income as well. Many investors repeat this process again and again, generating recurring income from stocks that they already plan on holding long term. But there is a risk of limited upside. And this is where many beginners misunderstand covered calls. If the stock suddenly surges higher, your upside is capped at the strike price. If it goes above the strike price, the buyer of the option will have those shares, not you. So if the stock jumps to, say, $150, you still have to sell your shares at $110. Now, you keep the premium, but you miss most of the upside move on the stock. And this is called opportunity cost. Now, there's also downside risk. Covered calls do not protect you from major stock declines. The premium helps slightly, but if the stock crashes, you still absorb most of the losses because you still own the shares. You can, of course, sell the shares at any time, but remember, if you do and the option still exists, you will now have what is known as uncovered call option or a naked call option. And these are very high risk because if the stock suddenly rises and goes above the strike price, you will be required to sell the stock that you no longer own at the strike price. And so have to go into the market to buy it, by which time the price may be significantly higher. So the option premium acts more like a small cushion, not a true hedge against large market crashes. Now, covered calls are often used by long-term investors, retirees seeking additional income, and investors who believe a stock will trade sideways or just rise slowly. Covered calls generally work best in slower or sideways markets and less well during explosive bull runs. Now let's just look at 3 beginner mistakes. One beginner mistake is setting strike prices too close to the current stock price, which increases the chance of losing the stocks quickly. The second beginner mistake is writing covered calls on extremely volatile stocks that can suddenly explode upwards. And the third beginner mistake is large premiums. They look attractive, but they often come with significantly higher risk. If the premium is high, you have to ask yourself why. Is it because the stock is highly volatile and so has a higher likelihood of exceeding the strike price? Is it because there is a long time before expiry date, so there's more time for the stock to rise above the strike price? Understand the risk before you take the money. So, in summary, covered calls can generate additional income from stocks you already own, especially when using strike prices moderately above the current stock price. But remember, you are trading unlimited upside for immediate premium income. Thank you for watching. Please comment on any further stock option strategies on which you would like to receive more information. If you want to understand investing in stock options or any other financial investment without the confusion, please click on the subscribe button and join us here at Valkyrie Simple Finance. Remember, understanding always should come before investing.